Savvy taxpayers have been using S corporations to reduce their taxes for decades now, all while building fortunes of wealth. Yet, many business owners are still not taking advantage of the S-Corp designation, and those that do still miss out on some of the most powerful tax reduction strategies that are available. So in this episode, I want to walk you through the most powerful S-Corp tax strategies that I personally use to help my clients save tens of thousands of dollars in taxes every year at mycpacoach.com. If that sounds good to you, go ahead and like this video, subscribe to our channel, and drop a comment with any questions you may have. All right, so let's start with the primary reason why most business owners elect to become an S-Corp in the first place, and then we will get into some more advanced tactics here. So listen up. Strategy number one, avoiding self-employment tax. If you have not already formed an S corporation, then this is the reason why most people make the switch, okay? If you operate as a self-employed individual, earn 1099 income, or have a business that is set up as an LLC, partnership, or sole proprietorship, then your business income is subject to a 15.3% self-employment tax up to a certain limit. Now, keep in mind that this is an additional tax. You still have federal income tax, which ranges from 10 to 37% of your income. And you still have state income tax, which could be up to another 13% tax on your income, depending on your state. And now we have an additional 15.3% self-employment tax on all of your business income up to about $170,000, and still taxes up to 3.8% on income above this threshold in the form of Medicare tax and net investment tax. Now, here's the beauty of the S-Corp designation. S corporation income is not subject to self-employment tax, Medicare tax, or net investment taxes. Instead, shareholders of S corporations must take what is called a reasonable salary that is subject to employment tax, which is basically how the IRS collects some tax revenue from S corp owners. Now, the difference is that those employment taxes are not self-employment taxes. Self-employment tax is on 100% of your business income, whereas employment tax is only on the W-2 wage you take from your business. It is not assessed on your remaining business income. That's where the tax savings come into play with the S corporation. For example, if your business was not an S corp and earned $150,000 in business income, you would owe about $23,000 in self-employment tax alone. But if you were an S corp and had the same amount of income and took, let's say, $60,000 in W-2 wages, you would only then pay about $9,000 in employment tax, ultimately saving you about $14,000 in taxes alone. An S corp immediately saves you money in taxes by shielding your business profits from self-employment tax and only allows the IRS to assess that tax on your W-2 salary. Now, your salary should be reasonable, or in other words, reflect what you would pay someone else to perform the same job responsibilities that you perform for your company. But you have to be careful here because you can pay yourself too much in W-2 wages, and that can negate a lot of the tax savings. Typically, you want to keep your salary as low as reasonably possible to save the most money in taxes. And you don't want to confuse your salary with your distributions. Remember, you should only get a salary for the work you do in your business. And you should only receive a distribution for your share of profits, or in other words, your ownership that you have in the business. And those distributions are what we do not pay self-employment tax on. So be sure to carefully review your salary with your CPA for the best tax advice. Now let's move on to the next strategy here. Strategy number two, reimbursing yourself from the business. As an S corporation, you and the business are considered separate entities for tax purposes. This means that if you use any of your personal resources to operate your S corp, then your S corp should be reimbursing you for those expenses. And furthermore, when it does reimburse you for those expenses, that reimbursement is tax deductible for the S corp and lowers your overall tax liability. So what expenses then can the S Corp reimburse you for, and how does this work? Well, first of all, the technical thing that you would need to have set up through your S-Corp is called an accountable plan. Now, this is simply a reimbursement policy that explains how the S-Corp will reimburse you for business expenses you pay for personally. Now, the types of expenses that the S-Corp can reimburse you for varies and can cover a broad range of things. But the major things that save my clients a whole lot of money in taxes are reimbursements for home expenses, travel expenses, meal expenses, car and vehicle expenses, health insurance premiums, and so much more. If any portion of these expenses are used to help run your business in any way, then you can typically write off a portion of those expenses on your S-Corp tax return. And how you would go about doing that is simply having the S-Corp reimburse you from the business bank account to your personal bank account. We're basically creating a transaction here, which is an expense for the S-Corp under the accountable plan and is therefore tax deductible. And since the remaining of the income that we have in the S-Corp will be taxed on your individual return anyway, this tax deduction ultimately saves you money in taxes at the end of the day. But what if we could add family members, friends even, or other members to your business to create even more tax deductions? This next strategy explains this. Strategy number 3, creating a board of directors. So a lot of S-Corp owners do not know this, but as an S-Corporation, you are actually required to have at least one annual shareholder meeting, which is required by most states. The good news is that this provides you with the opportunity to then create a board of directors for your S-Corporation, which could then open the door for you to write off more of your expenses. For example, if your kids, spouse, parents, or friends sat on your board of directors as an advisor to your business, then all of a sudden they are associated with the business as legitimate business contacts. And since they are now business contacts, the expenses you incur to conduct these meetings with these individuals are now tax deductible. For example, if your board meeting required travel, lodging at hotels, dining meals, and event space, you could write off all of these expenses as business deductions on your S-Corp tax return. So if you paid $5,000 to pay for their flights, hotels, and transportation, then the entire $5,000 fee could be tax deductible if they are board members for your business. But if they were not associated with the business in any way, then the expense would not be tax deductible because they are not affiliated with your business. Therefore, by adding family members like your kids, spouse, and parents to sit on your board as advisors, you open the door to write off more of their expenses. But this strategy is not just limited to travel expenses. You could create deductions right at home. For example, your S-Corporation could host board meetings at your personal residence, and you could charge your S-Corporation a fee for using your personal residence for those business meetings. Under the Augusta rule, that fee will be tax deductible for the S-Corp and tax-free to you as long as it is not done more than 14 days per tax year. So if you charge your S-Corp $1,000 per day to rent your residence, you would have a $14,000 tax deduction at the end of the year if you did this 14 times. Now, this would not be possible without having legitimate business contacts to meet with, which is why creating a board of directors could be very beneficial. Not to mention the fact that ideally these meetings are helping you grow and manage your business, allowing you to build more wealth. Your board meetings can be used to discuss your business performance, strategic plans for the future, or other matters that may help you grow your business. But at the end of the day, these board meetings should be productive for your business, and you should maintain meeting notes that document all of your discussions and outcomes that are associated with these meetings to protect yourself in the event of an IRS audit. Strategy number 4, S-Corp retirement plans. So as an S-Corporation, you have the ability to set up retirement benefits that directly benefit you as the owner and saves you significant money in taxes. If you use a traditional retirement structure, you can essentially write off every dollar you put towards your retirement up to a certain limit. For instance, if you do not have any employees other than yourself, then you could set up what is called a solo 401k and put upwards to $75,000 per year, depending on your age and income. If you do have employees, then you could set up a standard 401k plan and put upwards to $30,000 per year in that account. Or if you're very big on saving for retirement, you could even set up a pension through your S-Corp and potentially contribute upwards to $300,000 per year in one given tax year. Now, obviously, this is going to be very different for every person watching this video. Some people may only put a few $1,000s aside for their retirement, while someone else may decide to max out their retirement to the furthest possibility. But my overall point here is to illustrate that you could create very big tax deductions for yourself and the S-Corp by creating a retirement plan through your S-Corp. Now, some people may argue that you should structure these plans under a Roth structure instead of a traditional structure. And believe me, using a Roth certainly has its place, but if you're in a very high tax bracket right now, like above 30%, and sometimes even in the 20% level, then the traditional retirement structure could save you much more money in taxes than a Roth. But I already have a separate video on that topic, so be sure to subscribe and check out that video to learn more. But let's move on to the next tax strategy here. Strategy number 5, setting up fringe benefit plans. Now we're really about to milk your S-Corp. So did you know that you could create a dependent care assistance plan through your S-Corp that pays a portion of all of your child care expenses, which is 100% deductible for the S-Corp? Or did you know that you could set up an educational assistance benefit or even a tuition reimbursement program and write off the entire cost through your S-Corp? You could even set up a gym or athletic facility and write off the expenses through your S-Corp as valid business deductions, and so much more. Now, these are called fringe benefits, which the IRS views as a type of compensation to employees of your S-Corp. However, certain fringe benefits like the ones I just mentioned are excluded from the employee's income and are still tax deductible for the S-Corporation. So look, if you do not have any employees in your S-Corporation, then great. You can design fringe benefit plans that solely benefit you as the only employee of the S-Corporation. But if you do have employees, then you want to be careful here because any fringe benefit you create must also extend to other employees in your company. In those situations, it may be appropriate to set up a separate management company to run these sorts of tax strategies through, which I'll save for another video. But in addition to that, another thing you need to know is that some fringe benefits are actually taxable as income. So you need to be fully aware of which benefits are treated as taxable income and which benefits are excluded from taxable income. For instance, if the S-Corp pays to help their employees move or provide achievement-based awards, the cost of those benefits are actually taxed as income to the employee. So you have to be careful here. When you get to this level of tax strategy and you want to start maximizing the full range of benefits of your S-Corporation, then it actually saves you more money to have a strong CPA in your corner who can guide you through setting up these types of things correctly. And if you need one, just head over to mycpacoach.com to apply to work with my team today. Thank you.